What I like to look for are unique and irreplaceable assets, or at least assets that you can't really find anywhere else. Like, for example, if you're looking at a hotel REIT, anybody can own an extended stay hotel, like a standard extended stay building. Not everyone can own a giant conference center or a hotel with a big entertainment venue attached to it or something to that effect. Not every office REIT owns the Empire State Building.
You are listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth. Hello, I'm Deidre Woollard, editor of Millionacres. Thank you so much for tuning in. Today we are talking to Matt Frankel, who's one of the most prolific and knowledgeable writers on Millionacres, as well as a certified financial planner and a senior analyst on our premium mogul service. So in this episode, we're going to go over the basics of REITs, how to really consider them as part of your investment portfolio. So REITs can be a great way to dip your toe into real estate investing, partly because many of them are publicly traded on the stock market. So we're really excited for this. Hi, Matt. How are you doing?
Good. I am enjoying a day in my office. I am not in my house, so it's a pretty good day.
Awesome. So let's get started. First of all, how did you first start investing in REITs?
By accident, I guess you would say. I stumbled upon it. I was reading through some stock forums. This was about a little over 10 years ago, and I stumbled across a company called Realty Income that we've talked about a few times before. And I started digging into it, and I just kind of got fascinated with the whole business model and wanted to learn more about what a REIT is and how it works and why it can be such a long-term investment. And the reason was because Realty Income, normally you think of real estate as kind of a boring investment. A lot of investors do that don't really know much about it. And I was reading a statistic in their presentation that since their IPO, they had beat the S&P 500 handily, and on a consistent basis and with less risk than you're taking in most stocks. So it just, the bell went off in my head. How do they do that? And so that's what kind of got me started looking into REITs. And the more I learned, the more I liked.
Nice. Well, I know one of the things that I like about Realty Income also is it is dividends. It considers itself the monthly dividend company. So we definitely want to talk about that today. But one of the reasons that you and I are interested in REITs besides dividends is that it's a great way to invest in a variety of real estate sectors. You can kind of dip your toes into commercial real estate in an easy way. So one of the things I personally find really exciting about REITs is you can invest in warehouses, you can invest in some of the world's most recognizable buildings. So I think that's one of the things that's really exciting about REITs.
Yeah, REITs were created to kind of open up an asset class that had historically been the realm of the rich to everyday investors. Not many people listening here could go out and buy a shopping mall, for example. And even if you could, would you really know what to do with it after you closed on it? REITs allow you to invest in not just one, but a whole portfolio of shopping malls if you want to, or office spaces like the one I'm in right now, or, I mean, the Empire State Building is a publicly traded real estate company. So it really just opens up this asset class that, like I said, was once just the realm of rich developers to everyday investors. And it's a really exciting asset class. And it's no wonder these rich developers were interested in it for so long. And now anybody can get a little piece of the action.
Awesome. Thank you. So let's go back to the basics. What makes a REIT versus being a traditional company?
Sure. Well, the easy answer is REITs are companies that primarily own and invest in real estate assets. But you can't just go buy a bunch of properties, incorporate, and call yourself a REIT. You have to meet certain requirements first. There's a list of requirements. I won't bore you with most of them, but there's a few significant ones. One, a REIT has to have at least 100 shareholders. This is why most REITs don't start out as REITs, because if you're just running a real estate partnership with 3 investors, for example, you can't just call yourself a REIT. So as more investors come on, then partnerships will transition to being REITs. A REIT has to invest at least 3/4 of its asset in real estate investments and must derive at least 3/4 of its income from those real estate investments. So REITs can own other businesses. There's one REIT I know of that owns a concert venue. So that's not necessarily real estate income, if it's selling merchandise and things like that. One owns a restaurant chain that I know of. But at least 75% of their income has to come from real estate. And third, and the most publicly known requirement is that REITs need to pay out at least 90% of their taxable income in order to be considered REITs. If they do this, they get to avoid corporate taxes. Most stocks are taxed effectively twice. I own shares of Apple, for example, and the profits that Apple makes are taxed on the corporate level when Apple earns them. And then when they pay me a dividend, that's taxed on the personal level. So that same money is taxed twice. REITs get to avoid that and become essentially pass-through businesses. By paying out at least 90% of their taxable income, they don't have to pay any corporate tax whatsoever. And over time, this can really add up to a big tax advantage for investors.
So it sounds like a lot of rules. So what are the advantages for a company to become a REIT? You mentioned that partnerships sometimes transition into REITs.
Taxes are, I'd say, the biggest benefit of becoming a REIT. There's a few other legal reasons you might want to be a REIT, but the taxes to be a pass-through business, especially after the Tax Cuts and Jobs Act brought the 20% deduction for pass-through income, because REIT investors are allowed to use that. You're considered to have a pass-through business if you're a REIT shareholder. And because they avoid corporate taxes, it makes them ideal investments for retirement accounts. Retirement accounts, you don't pay income tax whatsoever on those until you withdraw the money as income. So with a REIT in a retirement account, you could avoid tax on both the corporate and personal level. So it makes them really an ideal compounding machine for retirement accounts.
Nice. Always love to hear that. So I know when we start talking about REITs, the first thing is that there are two main types, equity and mortgage REITs. Can you explain the difference between the two?
Yeah, usually when someone says the term REIT, they're talking about an equity REIT. An equity REIT is the kind that owns properties. If a company primarily owns physical buildings, they're an equity REIT. A mortgage REIT owns financial instruments such as mortgage-backed securities. Some own mortgage servicing rights, things to that nature, not actual properties. They own the mortgages and the financial instruments behind real estate. They are such different investments that mortgage REITs aren't even part of the real estate sector. Mortgage REITs are technically included in the financial sector, like banks. So they're a very different type of investment. Mortgage REITs, the primary goal is income. What mortgage REITs do is they borrow a lot of money at low interest rates to buy a bunch of mortgages that pay higher interest rates and make a profit off the difference. And they pass that income through. If you look at some of the popular mortgage REITs, they pay dividends in the 10% range, and sustainably, because they're not trying to grow the principal. They're just trying to produce as much income as possible at a safe level. So equity REITs, on the other hand, are what are known as total return investments, meaning they want to provide a combination of income and growth. I mentioned that REITs have to pay out 90% of their taxable income, so the average REIT pays out more than the average stock in the S&P 500. But at the same time, properties appreciate in value over time. REITs can employ other strategies like what's known as capital recycling, strategically selling one property and buying another one that has more growth opportunity to create more shareholder value. So equity REITs are really total returns. They want to increase shareholder value and produce a nice stream of income over time, whereas mortgage REITs are really just income investments and are very, very different, when you're trying to analyze them and things like that than equity REITs. Normally, the term REIT and equity REIT are used interchangeably.
Interesting. Thank you. And I know also I've heard that mortgage REITs sometimes can be a little more volatile.
Yes, for sure. They're very reactive to interest rates. All REITs are somewhat reactive to changing interest rates. For example, if the federal funds rate spikes really quickly, it's generally a negative thing for equity REITs as well. But it can be really devastating to mortgage REITs. Mortgage REITs, I mentioned earlier, they borrow at lower short-term interest rates to buy mortgages that pay higher long-term interest rates. Well, if those short-term interest rates spike, these mortgage companies have a portfolio of mortgages that are paying one rate, and if the short-term rate they have to borrow at spikes, the gap between those narrows, and their profit margins can evaporate really quickly. Mortgage REITs have ways of counteracting that, buying interest rate swaps and other derivatives to kind of hedge against interest rate rises. But they're very reactive to rising interest rates. They're very reactive to falling interest rates because that makes a lot of prepayment risk. People refinance as we've seen in the past few months. People refinance their mortgages in record volumes if mortgage rates drop. I think mortgage refinancing is more than doubled year over year in the second quarter. So that also creates a problem for mortgages because they're buying these mortgage securities that pay out a certain amount of interest. And if people prepay them, they're not getting any interest. So the prepayment risk is a big thing for mortgage REITs. So they're very reactive to interest rate swings up and down. Mortgage REITs do the best when interest rates remain steady. Interest rate swings to the upside or the downside can really wreak havoc on mortgage REIT profits and their share prices as a result, which is, if you look at a 3-month chart of pretty much any mortgage REIT, you'll see exactly what I'm talking about.
Great. Well, let's turn back to equity REITs for a minute, and let's talk about why investors would like to have REITs as part of their portfolio. Obviously, there are the tax benefits you mentioned, but I think another thing that's important for people to understand is that REITs tend to act a little differently than some of the rest of the stock market.
Yes, and as we've seen during the COVID pandemic, this could be a good or a bad thing, depending on what kind of REIT you have. REITs, real estate as a general asset class, is not as reactive to economic swings in general as the overall stock market. If you look back at the 08-09 market meltdown, which was caused by real estate actually outperformed the S&P 500. But what you've seen in the COVID pandemic, real estate has moved not with the stock market, but in a bad way. Real estate was one of the worst performing things just because it's a physical building and it depends on people being able to go places, and that hasn't been a thing recently. But generally, real estate, it adds an element of diversification to your portfolio because real estate is not considered to be the same asset class as stocks or bonds.
Well, and I think one of the things that's happened certainly with the pandemic, but in general with REITs, is because there are so many different sectors, you see them acting differently. One of the things that we've seen is industrial real estate, so warehouses that are e-commerce and things like that. Data centers have performed relatively well, whereas malls and hospitality, not so much. So let's talk a little bit about the different types of REIT sectors and the ones that you look at.
Yeah, so there's a lot of different, I want to say 11 different REIT sectors according to the official database. But so residential is one of them, just a big one, apartment buildings. Most residential REITs own apartment buildings. Hotel REITs are another one. Office REITs, there's industrial REITs, which are warehouses and things like that. Like you mentioned, you can own warehouses. There are healthcare REITs that own properties like hospitals and medical offices. There are what are called diversified REITs that have kind of a mixed approach to investing. There are communications REITs that own cell towers and things like that. There's data center REITs that own these big sprawling data centers that companies like Facebook and Google keep all their network equipment in. I could go on with that, but the point is different REIT sectors can react very differently to economic swings. There's a few variables. One is lease length. When you think of an office building, the average office tenant signs a lease that's like 7 to 10 years long, I believe. The average apartment tenant signs a lease that's 1 year long. The average hotel tenant signs a lease that's a day. They rent hotel rooms by the day. Self-storage is another REIT category. Their tenants sign month-to-month leases usually. So that's one big thing. The other is just the cyclicality of the underlying business. Offices are generally not cyclical. Office tenants, in bad economic times, companies still need office space. In bad economic times, companies still need healthcare, so healthcare REITs aren't very cyclical. On the opposite side of that, hotels, in bad economies, people can easily cut back on their travel. And not to mention that, but their lease length is 1 day. So hotels get the worst of both worlds. Hotels are by far the most cyclical type of REITs. Apartment REITs, for example, are kind of a mixed bag. They have a short lease length, 1 year, but people still need places to live no matter what the economy is doing, which tends to help. So apartment REITs are kind of in the middle when it comes to cyclicality. Healthcare, I would say, is the least cyclical type of REIT, meaning least economically reactive. It's by far the most essential service of any REITs. I mean, you've got nothing if you don't have your health. So people need access to healthcare no matter what the economy's doing. And healthcare tenants tend to be on long-term leases. And the switching costs are very high when it comes to healthcare properties and office properties and things like that. Like it's rare that a doctor just packs up and moves to another office without a valid reason, like expanding their practice, or it's rare that a hospital just vacates and moves to a different building. So it's that there's a big spectrum when it comes to the reactivity or the volatility of REITs. So it's not, while we think of real estate as just one sector, there's a big broad spectrum within it.
Well, that brings up an interesting point, too, is that we talked about diversification, within REIT investing, you can also diversify, and you can have some industrial and some hotel and some office and sort of really balance your portfolio that way as well.
Sure. I think I own about a dozen different REITs right now. If you don't want to own a dozen different REITs, there are index funds that just allow you to invest in the real estate sector as a whole. The Vanguard Real Estate Fund, ticker symbol is VNQ. If you don't want to do a bunch of guesswork, really is a market cap weighted real estate index fund that gives you 100, 120, I believe, REITs in your portfolio in one single investment. But having said that, yeah, you could definitely diversify. If you have a portfolio of hotel REITs and a portfolio of office REITs, those are two totally different types of risk profiles. So, for example, I own a hotel REIT, I own an apartment REIT, I don't own any mortgage REITs, but I own an office REIT, an industrial REIT, it's et cetera. So it really it's kind of like my own little stock portfolio within a portfolio, I think of it as. And it's really because I'd call a moderate risk tolerance at this point. I don't want to put all of my money into a hotel REIT, even though if things work out really well, that could be the best long-term return. Or retail for that for that matter. I don't want to put all my money into a mall REIT right now. If it could go to zero, or it could quadruple in a few years if all things go well. But I'm not willing to take that risk. So it's important to diversify, especially if you want exposure to the more volatile sectors or subsectors of REITs in your portfolio.
That is a really good point, too. And so right now we're recording this in sort of the heart of second quarter earnings season. So it's a good chance to sort of talk about the fundamentals and what you really look for when you're evaluating REIT. I know it's a little bit different than the process you would use with your traditional publicly traded company.
Well, just like it is and it isn't. At the end of the day, you want to make sure you have a good business. So first and foremost, I want to make sure that the business is sound. I want a sector that has long-term, or a business that has long-term growth potential. I want a business that is well run. I look at the management team. I look at things that cannot be quantified with numbers first and foremost before I look into any real analytical parts. So what I would say is make sure you're investing in a good business first. Going beyond that, the numbers are a little different, as you said, between the rest of the investment world and the real estate world. Just for example, when you're looking at a stock, what's the first metric you think of? Probably earnings per share, or the price to earnings ratio, or something to the effect of earnings. In real estate, that doesn't really translate well. I don't really want to get into the mathematics of it, but there's a metric called depreciation in real estate that really distorts profitability. It's good for investors because it makes taxable income much lower, but it's bad in the sense that it makes it tougher to evaluate just based on traditional methods of calculating income. So in real estate, you want to focus on a metric called funds from operations, or FFO for short. You don't really need to know the calculation just because all REITs report it with their earnings. But what you need to know is that that's the best measure of how profitable a real estate investment trust is, and how much money it has available to pay dividends, how quickly its earnings are growing, and things like that. So that's the one metric that really doesn't translate well at all from from traditional investments. And beyond that, you want to look at things like vacancy rates, or occupancy rates rather. If a REIT's occupancy rates are falling, that's generally a negative sign. You want to look at the payout ratio. If a REIT's dividend is more than its FFO that I was just mentioning, that might be a sign that its income is unsustainable. So a lot of metrics translate really well, but you just need to know a few real estate specific things in order to be able to effectively evaluate these stocks. But above all, like I said, I want to reemphasize you want to invest in good businesses first. If you invest in good businesses first, the valuation is kind of a secondary thing. You can invest in cheap stocks all day, but if they're not good businesses, you're not going to do well in the long run.
I agree. And I know one of the things you and I have talked about before in the past is the importance of good management in a REIT. And that's true in any company. So I know that there's a lot of REITs that are on the stock market, but there are also some that aren't. Can you explain how you invest in those types of REITs?
Yeah, so there are actually three different types of REITs when it talks to investability. There are publicly traded REITs, which is what we're talking about right now and what I invest in. There are what are called public non-traded REITs that anybody can invest in, but they work more like an investment partnership than a publicly traded stock. There are a bunch of non-traded REITs that you could find listed in. There's a ton of different directories for these. NAREIT, NAREIT.com, I believe is where they keep a really good directory of all the non-traded REITs. So those are REITs that anybody can invest in, but they're just not listed on an exchange. Then you have private REITs, which are not listed on an exchange, and you kind of have to be accepted as an investor. So those don't have to just accept anybody who wants to invest. So those are the three different types of REITs. I generally suggest sticking to publicly traded REITs. They're more transparent with the management costs and expenses and really how they're using your money. A lot of private REITs have big sales commissions right off the top. Kind of think of like a mutual fund with a sales charge. So that's something that you can sometimes get suckered into with a non-traded REIT. There are some good ones, but it's a lot less transparent is the point. And I like to stick to the publicly traded sector.
And I think another thing that is important there too is that you can get in and out of a publicly traded REIT much more quickly. Some of the private REITs and non-traded REITs may have rules about when you can take your money out, which could be a factor for a lot of people.
Yeah, a lot of the non-listed REITs, it's a very good point. A lot of the non-listed ones only let people redeem their shares quarterly, if that frequently, at a predetermined price based on the REIT's assets. It's not a liquid market. If I wanted to sell my realty income shares while I'm talking to you, I could with a simple click of a button. So it's a different kind of dynamic. Like I said, if you're a new investor, I'd say proceed with caution when it comes to non-traded REITs of any kind.
Great, thank you. So I want to talk to you a little bit about taxes and REITs, because REITs and taxes are a little bit different than other companies. And so let's talk a little bit about how that works.
Sure. Well, we mentioned the taxes to the REIT itself. REITs don't pay corporate taxes at all. On the individual level, assuming you're not holding them in a retirement account like an IRA, REITs can be kind of complex on the taxation side. For one thing, most dividend stocks pay what are called qualified dividends, which all you really need to know about that is a qualified dividend gets the preferable tax rates that capital gains get. If you search capital gains tax rates, those are the rates that you pay on most stock dividends. REITs, on the other hand, generally don't meet the definition of qualified dividends, meaning that you'll have to pay your ordinary income tax rate on your REIT dividends. Now, to further complicate matters, not all of a REIT's dividend is usually of the non-qualified kind. A REIT will send you a breakdown of its dividend distributions at the end of each year. Some of them, the vast majority will usually be non-qualified dividends, meaning they're taxed at ordinary income rates. Some may be qualified dividends, depending on how the REIT made the money, and some could even be considered a non-taxable return of capital, depending on how the REIT made its money. For example, if it sold properties at a profit and is passing that money on to shareholders, that could be considered a non-taxable return of capital in that situation, which serves to just kind of reduce your cost basis in the shares. So if that doesn't sound complicated enough already, REITs also qualify for the 20% qualified business income deduction, but only the portion that's considered ordinary income, which is a good tax benefit. It generally brings your tax rate down to a comparable level as if you had a qualified dividend, but it's a more complicated calculation to get there. So REIT dividends, two things you need to know: they're not qualified dividends and they're complicated. if I were to break all that down into two things.
Well, and also one thing to make people feel a little bit better is that it will be broken down for you, correct?
Correct. The REITs will send you a tax form at the end of the year with all this broken down for you. You can usually import it right into whatever tax software you're using, like TurboTax. You could just import it right in there, and it'll do the calculation for you. But it is a more complicated tax situation. If you are in a higher income bracket especially, you could find your effective tax rate on REIT investments higher than on normal stock dividends. So that's just something to keep in mind as you invest in REITs in non-taxable accounts. They're ideal candidates, again, for retirement accounts. But if you're going to invest in them in a standard brokerage account, just be aware that the tax treatment's a little bit different.
Awesome. Thank you. So that's one potential disadvantage, perhaps, of investing in REITs. Is there anything else that you would categorize as a disadvantage?
Not really, just the more complicated tax structure. And, a lot of the analytical methods don't necessarily translate. But other than that, I wouldn't call anything about REITs really a big negative.
So I just want to leave people with sort of a how-to if you're a beginning investor and you've seen REITs, you're curious about them. What do you need to know first? Where should you start? I mean, obviously, I would tell people to start at Millionacres because we have a lot of fantastic REIT content, and
we're a little biased though.
We are very biased. But if I'm just starting out as a REIT investor, where should I start looking?
I actually checked the website. It's not nareit.com. It's just REIT.com is the National Association of Real Estate Investment Trusts. They have some fantastic educational resources. Like I said, there's a directory of all the different REITs that trade on the public, non-traded, and the private markets. There's a lot of educational kind of what is a REIT, how to look at REITs, REIT statistics, REIT historical performance. They have some great statistics there. So I would recommend that as a great resource. Your broker likely has a lot of educational resources. Some, like I use TD Ameritrade, for example, they have a lot of third-party research reports on a lot of the major REITs that could be a great way to learn more about the companies from an analytical point of view without really having to know too many analytical methods yourself. So those are the two big resources, other than Millionacres, I would recommend that you try.
Awesome. Thank you. One of the things that in stock investing we talk about sometimes is taking a look at what you use in your everyday life and becoming interested in companies that way. Do you feel like that's also true for REITs, that you can sort of look at the hotels that you may be interested in going to, or seeing what office buildings are in your area and seeing what REITs they're a part of?
Yeah, you can definitely check out your local market. I know right down the street, there's a mall owned by a major REIT. There's an office building owned by a major REIT right here, and a hospital owned by a major REIT not far from where I'm sitting right now. So that's one way of looking. What I like to look for are unique and irreplaceable assets, or at least assets that you can't really find anywhere else. Like, for example, if you're looking at a hotel REIT, there are some good REITs that own these, but anybody can own an extended stay hotel, like a standard extended stay building. Not everyone can own a giant conference center or a hotel with a big entertainment venue attached to it or something to that effect. Not every office REIT owns the Empire State Building, or not every apartment REIT can buy urban high-rise apartment buildings. Those are kind of unique assets that are very difficult to get into that business. High barriers to entry, and are very irreplaceable, are difficult to replace, or difficult to be competed against. So those are the things I really look for. But your local market is a great place to start if you want to start getting some ideas. And you'd be surprised how many buildings you go into all the time that are owned by publicly traded REITs.
Absolutely. That's one of the things that I find really fascinating about REITs and really kind of almost enjoyable as an investor too, is to know that I'm part of a city and its growth.
Right, like I'm a part owner of the Empire State Building. It's kind of neat. How many other people can say that? Well, I guess everyone else who owns shares, but it's really a unique type of investment in that it's one that you can readily see. You can stand inside the building that you partially own, and it's just a really neat. It's an engaging type of investment in that sense. I know you could buy Apple and use your iPhone and say I helped put some profit in my pocket by buying this iPhone, but it's different when it's a physical building and a piece of real estate, or especially like an iconic asset, like the Empire State Building I keep talking about, or your favorite shopping mall that you've been going to since you were a kid, or something to that effect. There are a few good mall REITs out there, believe it or not.
Oh, absolutely. Well, this was fantastic. Thank you very much for your time. And I just want to remind people that Matt writes a lot on millionacres.com. You can read his perspective on all different types of REITs and get some of his picks for what he's watching right now.
Yeah, it's great to be here. I hope we do this again very soon.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. And if you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss, and Millionacres or The Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.